Let's get started. Okay, this is the last part of investing. This is part 3. I have highlighted important dates from the syllabus. That way you can go back and review what you need to turn in. If you have any questions, just let me know. Okay, let's get into what we're going to discuss today. I'm going to go as quickly as I can. It shouldn't take that long. So this is a summary of the first 2 presentations, part 1 and part 2 of investing. So we're going to go into where to invest your money and then education planning. That's the last step if that's part of your overall financial plan. So let's look into this. We're going to go also into the stock market versus the real estate market. How many of you like the real estate market or the stock market, or you're indifferent at this time? Okay, right now you're indifferent. Right now the stock market is down, the real estate market is down, so we need to determine what we need to do, if we need to wait, if we need to engage and possibly purchase an investment property, or you're looking into your first time home purchase. So we need to take all that into consideration, but I'm going to help provide clarity as you make these decisions in this type of environment, but also what does it look like when things go well? Obviously, your decision-making process will be a little bit easier to make that decision because you'll possibly have more money, maybe making more money, and the environment's more positive. I like the real estate because I work with it. Okay, great. If I worked in stocks, I would be, if I worked in stocks, I would be more comfortable with it. Okay, great. Thank you for that information. Hopefully the stock portion of things, the stock market, will help provide clarity, because I've known a lot of people that utilize both of them. But then again, some people are really good at real estate. That's what they do, and they know how to make money in it. So it's really a personal thing on what works best for you and your skill sets. So we'll also discuss sequence of risk returns, or sequence of returns risk. That shows you the timing of withdrawals from your retirement accounts. We'll go into that as well. Okay, let's look at this. Make sure you understand why you're investing into an investment. What's the purpose of it? What's the goal of it? You don't have to know every detail, but you need to know a little bit about what's happening, what your money is doing. You don't need to get to the point to where you're trading. You can if you want to go that far, but you get the idea. At least you need to know what is happening. Don't blindly go into something. And remember, you can work with the financial planner, you can work with the real estate agent, a loan officer. All of these people can help you make a decision, make sure it's affordable according to your budget. Does everyone agree with me on that? The advice with people that are experts in these fields sounds like you're well on your way because you work in the real estate business. It's very valuable to have the multitude of counselors around you to help you achieve your overall financial goals. Okay, we're going to go into the different types of investment vehicles. Which one is best? I'm going to give you some definitions. Just know the definitions. Some of these you may already know. First is mutual funds. This is a type of investment vehicle made up of a pool of money where you invest into stocks, bonds, money market instruments. That's a mutual fund. An ETF is a basket of single stocks that track an index like the S&P 500. They track a sector like a commodity. They may track like the technology sector. That is an ETF, and they work a little bit differently. I'm going to show you the difference between the two. This is what a mutual fund is. So you have people that contribute money into a mutual fund, and then you have a manager deciding where the money is going to go from the standpoint of which individual stocks they're going to invest into. It has a ticker symbol ending in an X. It's obviously with the expectation that it's going to grow, but you have a professional manager managing the stocks inside that mutual fund. Now, an index fund is a little bit different. It's an easy way to invest into every stock in an index like the S&P 500 in proportion to the size of the company. So you have like a USA 10 index fund, and it holds the 10 biggest U.S. stocks, and it would look like that in proportion to the size of the company. So that's what an index fund is. Now, there's a difference between mutual funds from the standpoint of active and passive. Active funds, and I showed you this before, active funds have a manager picking and choosing the stocks for you. It costs more money. Passive funds are index funds, and they track an index like the S&P 500, like the Russell 2000. It's much less expensive because you don't have a manager managing your money. But the idea behind having an actively managed fund is to see if the manager, and sometimes they do, sometimes they don't, can outperform the index. Because if you can outperform the index, because the index is going to perform as the economy performs, and it just tracks the index because it's an index fund. But if a manager can outperform the index, well, that's fantastic. It's well worth the cost. Is everyone tracking with me? Okay, great. Now, a lot of times, active managers outperform the index. Sometimes they don't. This is where you got to look at the historical returns of a fund and determine if they are outperforming the index. Because you would want, obviously, if you're going to pay the money, well, then it is outperforming, the manager is outperforming the index. Now, as we look at the difference between index funds and ETFs, you don't need to know all of this. The main difference here is ETFs, exchange traded funds, you can trade them like a stock intraday, throughout the day. An index fund, you can't do that. It just trades once a day. But other than that, they're very, very similar. Okay. Now, this is the number one sin when it comes to investing. Don't hold your contributions into your accounts in cash. Invest the money. That's what this is saying here. I've seen a lot of people that have not invested their money, and they think that after like 5 years, like they go back and review their account and it's still in cash and they haven't invested their money. Make sure you invest your money. That's what I'm saying. Okay, that makes sense. Now, this is the layers of investing. Hopefully this provides clarity for you on how this works. So you have your brokerage account, like you have, or I should say you have your brokerage firm. You have Vanguard, Fidelity, Schwab, like an Edward Jones. That's the clearinghouse. That's the brokerage firm. Then you open up an account through that brokerage, like an IRA, a 401k, that can be through your employer as well. And then it's funded with a mutual fund, an ETF, an index fund, and then inside of a mutual fund, ETF, and index fund are individual stocks. Does that make sense? That's how that works. Great. Fantastic. A lot of people don't know that, but now you know. Okay, we're going to go into bonds. What is a bond? Here's the definition for you. You can read that. I'm just going to show you the advantages and disadvantages. So let me go back to this. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, which is typically a governmental entity. So how that works is, for example, you want to buy a bond, or let's say an individual bond. You can buy a bond mutual fund through a brokerage firm. Say you want to buy an individual bond. So you would write a check to that brokerage firm and purchase that individual bond, say for $10,000, with the expectation to receive income with interest payments. So you pay on the principal, or you pay $10,000 for that bond, you're going to receive interest payments. You hold the bond into maturity, and then you're going to get your principal back plus your interest payments. So the $10,000 plus your interest payments over that time period, if it's a 10-year bond or if it's a 20-year bond. And you can profit if you resell the bond at a higher price. Now, there are disadvantages to a bond. Bonds pay out lower than stocks, the returns. Companies can default on a bond. So you want to make sure it's a very highly rated bond. It's a reputable type of project so that they can back up their interest payments and pay you the principal at the end of the period. However, bond yields can fall, and then that raises up. When bond yields go down, the price of bonds go up, and then they'll want to sell the bond and call the bond. So it can be a disadvantage for you in that regard. Does that make sense to everyone? Okay, that's the bond market. There's a lot to that market, but nonetheless, it is more of an instrument to create interest for you because you need that income. And a lot of people will purchase bonds as they approach retirement or they're in retirement because they need the income. But keep in mind, there are disadvantages to this. And this is where you can work with someone if you're in the bond market and you have individual bonds to determine if bond yields have fallen, then the price of outstanding bonds go up and they want to sell the bond to make sure you're managing that risk. But a lot of people will purchase bond mutual funds and they will buy and sell if they need to the bond mutual fund. They don't have to worry about the complexities of individual bonds, but that's what a bond is. And a bond mutual fund doesn't have a maturity date. It's designed to generate income for you throughout the life of that mutual fund. Now, there is what we call REITs, Real Estate Investment Trust. How many of you heard of this? This is a way to own real estate through okay, great. You can own real estate through a real estate investment trust. Now, you don't individually own the property. Okay, thumbs down, thumbs up. And a lot of people like to purchase this type of product because, in a sense, they are investing into real estate, but it's not an investment directly into the investment property. In other words, owning that investment property. You would own just the REIT itself, and it's designed to provide you with income throughout the life of that REIT, however long you own it. And you can own different type of real estate properties. It's managed by a professional manager. So it's income from real estate properties that they buy, manage, finance for themselves, and then you receive the income payment. You don't own and operate the properties. So is this a great investment option? So again, this is the definition where the company owns, operates, and finances income generating real estate and then passes on the income to you. Here's some pros and cons to this. A lot of people like this because they're able to receive a high dividend yield. But keep in mind, if you're receiving a dividend yield and it's in a taxable account, you will be taxed on that. If the taxes are delayed to a later date, say, for example, like a traditional IRA, you'll be taxed on the distribution. But it is something where you need to be aware of the taxes because it's designed to pay out income, and you could possibly be taxed on that if it is a taxable account. A lot of the indices already own real estate in them. So you may already have real estate exposure, and there's no need to buy individual REITs. So that's one of the cons. So keep that in mind. To me, you can have a portion of your portfolio in REITs if you want to go that route because it does provide a pretty good return over time and it provides a high dividend yield for you. So that's good. So there's always pros and cons. Now, where to invest? You can see the different categories here. In cash, doesn't do much at all. Bonds, a little bit better. Gold, a little bit better. However, stocks outperform, as you can see, since 1990, 500 a month. It is really staggering to look at the stocks. I want to show you this. Now, keep in mind, stocks outperform all the other asset classes. When I say your home in this situation, I'm not looking at your home as an investment property. This is not taking into consideration rental income. So throw that out. I'm just looking at the different asset classes, and stocks have outperformed bonds, gold, and in this case, your home if you're not looking at the rental income. Okay, is everyone with me so far? Okay, great. Now, this is as of this year. This is the importance of diversification and also how much risk you're willing to take. Year to date, the large US tech stocks like Apple, like Intel, they are experiencing a drawdown significantly. The S&P's down. Large tech stocks are down, -7%. However, international stocks are up almost 10%. So this is where diversification can help you. So what people will do, because we're experiencing a drawdown right now, is remember this chart, they will diversify with the asset allocation portfolio to capture all of the returns from each asset class, whether if it's positive or negative, because we never know. And you're able to produce a portfolio that provides at least a modest return, and you're able to get the diversification and not major drawdowns. Does that make sense to everyone? And this is year to date as of yesterday. So you can see international stocks are doing fantastic. Large cap, not so much. Small cap, not so much either. Okay, great. Fantastic. So you get the idea. Now, this is a great checklist, and we've gone through this. So you want to start investing. Make sure that you have your emergency fund, and then 15% of your income. Take full advantage of the match with your 401k if you have that through your employer. Your health savings account, make sure you're able to contribute into that. Sometimes it's either 10% of your income. If you can, max out your Roth IRA. That's tax-free income after the age of 59 and a half. Then if you have any money left over, you can max out your 401k. And then if you have money left over, you can invest into the taxable brokerage account unlimited. I don't need to go through all the other ones. You can read those yourself. That just shows you the progression of how you need to fund these accounts, because it can really, really generate power for you, because these accounts are tax deferred. They also are a way to help make sure that you have coverage for the expenses when you go to the doctor and you're planning for your retirement. You're taking advantage of free money with the matching contribution, and any money left over, you max out your tax deferred accounts and then your brokerage account if you can, which is taxable. Okay. Now, this is what people will do is, like I was showing you earlier, because of the risk that we're experiencing, and you can always work with the financial planner that you know, like, and trust. Make sure you understand the fees that you're paying that individual. But a well-diversified portfolio can minimize the risk associated with the stock market, especially with what we're seeing right now. And again, this is what they'll do. They'll make sure that you are diversified in an asset allocation portfolio to make sure that you capture all of the asset classes to have a portfolio that is giving you a great return, a substantial return, but you're reducing the drawdown. Okay, I want to show you this. This is one thing that people will do if you want to take the risk. I need to show you this because a lot of people want to invest into individual stocks and take the risk. This shows you the stock returns since initial public offering of these different stocks. So you can see Walmart, you can see Microsoft, Amazon, Apple, how much they're up since the initial public offering when they first entered into the market where you could buy that stock. Now, the thing is, we never know which company is going to be the next Apple. That's the thing. But if you're able to choose and pick the right company that's a startup, and then it is very prosperous over time, you can see it can create a lot of wealth for you, but you're taking the risk. This just shows you the winners. There are a lot of losers in this process. I just want to show you the numbers. It's staggering. If you invested into Amazon when it came out on May the 15th, 1997, the company split shares 4 times. And if you just bought a single share for $18 when Amazon first came out, it would be worth nearly $54,000 at today's share price. Not bad for an $18 investment 28 years ago. Just imagine if you had 100 shares and so forth. You can see the power of investing into one individual stock, But again, you have all of your assets in one basket and you take that risk. But then again, there's the trade-off. You can create a lot of wealth if you choose the right individual stock, the right company. Does that make sense, everyone? Yes, fantastic. So is everyone getting the idea of how we structure a portfolio? Okay, great. And this drives the point home. Okay, great. Thank you. If you experience a loss, and a lot of people are experiencing a loss right now. Some people have lost $40,000, $30,000. Now, it's not technically a loss until you sell, but nonetheless, on paper, when you're living it out and you see 30,000 lost in the market, you're like, what's going on? This is where the power of minimizing your risk is critical, because if you have a drawdown of 50%, you can see the number there. You need 100% to get back to break even. So keep that in mind. And a lot of people don't want to take this much risk. So it's not like you need to, if you're down 50%, you need 50% to break even. You need 100% to break even. Do you understand the math on that? I'm sure you do. So minimizing loss is critical here. If you can do that as much as you can, that is what I'm trying to tell you here. And there's some ways to do that if you don't want to take on a lot of risk. I'm going to show you this. This type of product is a product that people will look into when they're approaching retirement or when they're in retirement. How many of you have heard of annuities? Okay, great. Give me a thumbs up. Yes. This type of product is not appropriate for young investors, because a lot of you are young and you're able to weather the storm. You're able to take the ups and downs of the market. You don't really need income right now from your investments because you have a job, you're earning money, and your money in the stock market's growing over time. It's growing tax deferred. And you're able to, like I was saying, weather that storm. So as you approach retirement, say you're 65, 70, and you don't want to take a lot of risk. You can't afford to have a drawdown of 50% because you need 100% just to break even. So what people will do is they will purchase annuities, and there's different types of annuities. There's fixed annuities, variable annuities, and there's another type of annuity. I'll tell you that here in a minute. But a fixed annuity is a guaranteed stream of income for a certain number of years during retirement. It's like a personal pension. And a lot of people like this because there's no drawdown to it, and you're guaranteed that income every month for that number of years, no matter what. Then there's variable annuities. You make a purchase into the annuity, and it grows tax deferred. And a variable annuity grows tax deferred. A fixed annuity will grow tax deferred. It's designed to pay income immediately, a fixed annuity. But the variable annuity is different because you purchase the annuity and it provides a guaranteed income stream and a death benefit, but you could have a potential for higher income because you have a portion of what we call sub-accounts that have stock market-like exposure to give you a higher return, to give you a higher guaranteed income stream during retirement. And that's what we call a variable annuity. Does that make sense to everyone? Now, you purchase these accounts, it's an individual product, and you purchase an annuity. So it's outside of the 401k, it's outside of a Roth IRA. You have additional money left over, and you want to purchase an annuity to provide guaranteed income a lot of times for the rest of your life, and there's ways to do that. And a variable annuity is one of the ways to do that, and also has a life insurance component to it, because a variable annuity in particular provides a death benefit. So Whatever that amount is will be left to your beneficiaries in your passing, but it also provides during your lifetime guaranteed income for the rest of your life. Now, there is one thing that I want to discuss because this type of product is becoming more and more popular. You can see the fixed annuity, the variable annuity. You can go back and reference this. You won't get tested on all the details. Just know in general the definition of these types of products. There is what we call an indexed annuity. How many of you have heard of that? And also a fixed indexed annuity. I'm sure if you're in the real estate industry or in the banking industry, you probably heard of it. It's a fixed index annuity. Yes, it's becoming more and more popular. You need to understand these types of products are products that you pay for. You're paying for the guaranteed income stream. You're paying for the ability to reduce the drawdown. And there's insurance behind that. The company's insuring that the fact that they're not going to have a major drawdown and they're providing guaranteed income for you for that time period or for the rest of your life. And one of the products that they offer is a fixed index annuity. So they have caps and floors to the overall growth to provide principal protection, but also it's capped at a return, but also it is limited with a floor, so you will have what we call the power of zero. And I want to show you this. This is how it works. You can see the fixed index annuity, and then the red line is the S&P 500. That's the stock market. So in this case, this is as of 2023, the fixed index annuity, because it's not going any lower than zero, but it's not going any higher than, say, 8%, depending on the cap and the floor. And then every year you're credited an amount into your account, that amount will generate guaranteed income. And you can see the green line is the fixed index annuity, and off that accumulated value, you will say, I want income off that value, say, for the rest of my life. And a lot of people like this because it provides protection on the downside, but it limits your growth on the upside. But nonetheless, you're able to minimize the risk, and then it's going to allow you to have an accumulated value to generate guaranteed income for the rest of your life. Does that make sense to everyone? And in this case, the fixed index annuity outperformed the overall S&P 500. So it's worth considering at the appropriate time. That's the thing. To me, it's not anything that a young investor needs to invest into, but it's out there to where if you are worrisome about the market or you have money exposed to a lot of risk and you don't want to lose that, there are products where you can purchase to make sure that there is a reduction in the downside and there's protection there, and then you're also able to provide guaranteed income for the rest of your life. Okay. The last part is education planning. There are two different types. The Coverdell Education Savings Account. To me, this is, you can utilize these accounts above and beyond your other retirement accounts. These are specifically geared toward saving for education, but there's some limits to them. An education saving account allows you to save $2,000 with after-tax money. So it goes into the account, can be invested into a mutual fund, $2,000 every year, per child, but there's no federal income tax deduction. However, it is a tax-free distribution when it's used for qualified education expenses. So it really helps you out if you want to really enhance your ability to afford education. The other type of plan is the 529 plan. These are state-specific type plans. There's no limit on how much you can contribute with after tax, no federal income tax deduction. However, you can see many states cap the total amount. You can see ranging from $235,000 to $575,000. So it's a lot of money. And again, the distribution is tax-free as long as it's used for qualified education expenses. No income limits. There are income limits for the Coverdell Education Savings Account, but you can see the money for both gross tax deferred in both of these accounts, but used for qualified education expenses. It really works well. Side-by-side comparison between the two. You won't need to know the details. This is the main difference between the two. A 529 can only be used for tuition, while the Coverdell Education Savings Account can be paid for tuition and other school expenses. So that's the main difference between the two. Okay, is everyone with me so far? Okay, great, fantastic. Last but not least, you can have these accounts for children. It's the UTMA, Transfer to Minors Act, and the Gifts to Minors Act. Now there's a little bit clarification on the difference between the two. This account is in the child's name, controlled by the parent, the custodian, which is usually the grandparent or the parent. And the key thing is, until the child reaches age 21 for a UTMA account and age 18 for a UGMA account, the custodian manages the account, but at that legal age, it is their account to take it and use it however they see fit. But these types of accounts people will set up for their children and they'll invest the money. That's one way to fund education planning with these UTMA or UGMA accounts. But one of the disadvantages, obviously, at the age, when they reach legal age, it's their account. Okay, I want to discuss this. Stock market versus the real estate market. This is something you'll need to know. Someone was indifferent about the two different markets. This is what I've seen out in the field with the real estate market. Generally speaking, if you know what you're doing, you have a great location, you will make more money with real estate. You have a higher rate of return, an IRR, but it involves more time and hassle. The reason why is because the real estate market is an imperfect market. Every property is unique. All buyers and sellers never have the same amount of information and belief about a piece of real estate property. So you have better opportunities to get a bargain. If you put in the time, you should make more money with real estate. You have the appreciation in the property value. You have the deduction on your tax return. You have the rental income. You should make more money, especially if you have a great location for real estate. It's more of an imperfect market as opposed to the stock market. It's less hassle. You invest your money, you watch it grow, you can rebalance it, you're managing your risk. It's more of a perfect market where all buyers and sellers have exactly the same amount of information and exactly the same access to buy. So there's less opportunities to get a bargain, to buy low and sell high with the stock market. So that's the difference between the two. Is everyone with me? So you will make more money with real estate, generally speaking, than the stock market. So keep that in mind. I've known a lot of people that have become independently wealthy off real estate. That's why 90% of the millionaires own real estate. They have cash flow, appreciation. They can leverage and buy more property. The practicality, people need a place to stay. This is, to me, a great place to become a millionaire if you know what you're doing and if you have a great location. That's the key. And great tenants, too. And I've known people that buy investment properties, fix them up, and then sell them, and they do extremely well. Because the appreciation in home values historically has increased significantly over time. Sequence of returns real quick. It's the timing of withdrawals. Timing is everything. I want to show you this. This shows you the returns. You can see the blue investor, the green investor. The returns in year 1, 2, 3, and 4, and 5 were positive for the blue investor. For the green investor, the returns were -5, -6, -15. So the blue investor took distributions starting in year 1 of 5,000 when there was an up market. The green investor took distributions when there was a down market. Same average return. However, the blue investor has nearly 70,000 more, a little bit over 70,000 more than the green investor because of the sequence of returns. You were taking distributions in an up market. So what do we do here? We can't control the market. So what we need to do is to protect ourselves between this type of risk is start early, invest often, keep investing even after you retire. If you have earned income, invest into a Roth IRA, max out your Roth IRAs. You can open up a taxable account. You get the idea. The more you fund your retirement, the more chances of you obtaining a distribution from a market that is up. Well-diversified portfolio, well-balanced to reduce the drawdowns, and then consider working past normal retirement age. You're continuing to contribute more and more into your retirement accounts to make sure that you're prepared for any type of major drawdown. Okay, does that make sense, everyone? Hopefully that does. I'm going to go back to this real quick. This shows you the distributions every year. It's amazing how it works. When the markets do extremely well, it's fantastic. When they don't, we've got to be careful on how we make distributions from these types of accounts. A bear market's a down market, a bull market is an up market. So there are ways to protect yourself between these types of risks that we see within the overall market. Okay, I'm going to close on this. What type of money personality are you? Are you a compulsive saver, spender, a combination of both? You like to make money? You're indifferent? You can write in the chat. Do you worry about a gambler? Let me know which one you are. Okay, compulsive moneymaker and a worrier. Okay, that's a powerful combination there. You make money, but you worry, so it balances it out. Good, good. There's always that sense of the unknown. Compulsive saver, worrier. Yes, there's always that sense of an unknown. There's no guarantees in the overall market, but we want to look at the past and determine what is the best decision for the future. Right. You lose everything that I've worked so hard for. Absolutely. So the best advice I can tell you is make sure that you're not exposing your money to a lot of risk if that's the case, because there's risks outside of academia, like being able to spend time with your family, enjoy that time. You have peace within yourself. You're able to sleep at night. And if you take on too much risk, it's not worth it. So keep that in mind. Okay, I'm going to stop there. I'm running out of time. Thank you for your participation. You can provide a screenshot of this slide. If you have any questions, let me know. Thank you for being here. I appreciate everybody, and have a great week. Take care.